Hi, Dominique. Welcome to another edition of Key Events and Week Ahead. Hope you're well.
Thank you, Andrew. I hope you are enjoying the last remnants of summer.
Yes. Well, it's already started raining here this past week and a bit cooler in London, although it was sunny and actually I just played tennis. But now it's already dark and cloudy, literally a half hour later and about to rain, which is probably a good prelude to kind of the markets kind of on again, off again, kind of view of like the Fed maybe has things got it covered, or central banks globally. I maybe want to kick off. Obviously, we like to do is, I guess, any Fed comments over the past week, data, any important pieces of data that came out in the market to react to that. But one other thing I would say is there's definitely seemed to be a growing view, I think, certainly through Twitter, but some people that are, fairly smart people are starting to float these balloons of saying, maybe we will have a soft landing. So growth is okay, holding pretty strong. In some cases, maybe we say it's even getting stronger, and inflation's coming down, and maybe it's not coming back. So maybe between that, however you want to start, but maybe quickly kind of address that question as well.
Sure. So a soft landing is not impossible. I just think it's not the most likely outcome. I think what is happening at the moment is really two things or three things. You have inflation slowing down because you have two things working in opposite direction. One is the impact of the improvement in global supply chain on goods price inflation, so it's slowing. And the other one is that services price inflation is on an upward trend, but the trend is not strong enough to offset the decline in goods price inflation. But I think I shall be daring and use the word transitory. I think this is a transitory phase, simply because supply chains have improved. But I mean, if you do some shopping yourself, you know that it's not back to normal. And also, if you look at the big picture, what's happening in China, the war, the energy issues, energy shortages in Europe. In fact, one of my questions is, when are we going to use the word supply shock to describe what is happening in Europe? So we're not going back to pre-pandemic state in terms of global supply of goods. So there is that. And then if you look at the labor market, I mean, there is one simple reason why we keep having these positive surprises in employment. Actually, two reasons. Number one, as you alluded to, growth is not slowing. I think it's actually accelerating. And number two, labor is cheap. I mean, real wages have been falling. So if you are an employer and you can find people willing to work for you at current wages, of course, you're going to hire them. And eventually, you're going to grant those wage increases, because if you don't, you're losing business opportunities. And one last point I want to make about this, which is really important. Everybody is looking at the ratio of unemployed, the ratio of job openings per unemployed person. But actually, the thing they should look at is a ratio of actual hires to advertised job opening. And that last ratio is super low. And it's super low for a simple reason, which is that people aren't getting paid enough. In fact, I have a chart. I hope people will look at it in my review of Jackson Hole, showing the almost perfect correlation between the decline in the participation of prime prime male participation in plain language men between the age of 25 and 54. The decline in their participation is a perfect replica of the decline in the share of labor income in GDP. So you want more laborers, more workers, pay more, and they will show up. And that's what
I think that because of the uncertainty, let's just say a business says, okay, I can hire somebody comfortably at $20 an hour, but above that, I just don't know if I will continue to have the pricing power I have. There's enough uncertainty in the world, elections and the Russian invasion and all everything else. Is there some of that the uncertainty is holding businesses back, or is it just like, hey, you know what, I'm going to hold out for somebody to accept an offer for $20 an hour because I think I'm going to get it, and eventually they won't get it, and they will have to raise it to 21 or 22, and that's a 5-10% increase, and that's a lot over millions of people.
So you are spot on, Andrew. And in fact, one of the things that's been really striking lately in terms of uncertainty is the difference between the hard and the soft data, i.e. the survey data. And that difference is actually mapping very, very well to the economic policy uncertainty index. So in other words, we've had a huge decline in the economic uncertainty index. It's got really worse at the start of the pandemic. Then it got really better. And it's been falling since about a year and a half ago, but very gradually. So, and that really maps very well the behavior of like ISM that did very well in the recovery, and then really bad. And so as this uncertainty dissipates, and as people realize that actually, no, we are not in a recession, and we have to realize the recession talk has been going on for almost a year now. In the H1, there was the economy is in recession, which is there. So at some point.
Right. I mean, a lot of people were coming, really challenging you 3 months ago. What do you mean entering a recession? We're already in a recession. And now it's like, really? I don't feel like a recession is like 3.6% unemployment and like 400,000, 500,000 jobs a month. Like, clearly you've been right, and they've been wrong. Now, it's still possible that we could see a recession 9 to 12 months from here. Listen, if the Fed raises rates to 6-7%, something will break eventually. I mean,
no question.
No question. Yeah.
So, no recession. And so at some point, wage growth is going to pick up, and that's going to lift services inflation. And what is reassuring is it's not just me thinking that way, but I think the Fed. Because if you listen to what they've been saying, now they are starting to sing from the same hymn sheet, and saying that they need to bring down growth because below potential, because they need a cooler labor market to bring down wage growth, which is exactly my point. It's just we disagree on how high they will have to bring up the Fed funds rate, but there was a comment from Waller. So Waller is a board member. This saying that if inflation doesn't stabilize as he expects, the Fed funds rate will have to rise a lot higher than the 4% that is penciled in the last SCP.
Okay, and then just a quick update. Your call for the end of this year is what?
So I've been saying for a while now, 175 basis points, 75 basis points now, and 50 each in November and December.
So that puts us at
very embarrassing. I think it's
4.25, 4.5. Is that?
Between hold on, we are between 225 and 250. So I shall defer to the option specialist to tell me where we end up with.
So where are we now? With two?
We are between 2.5 and 250. So
So
we,
four and a quarter, yeah, so four and a
yeah,
quarter, 450,
yeah,
yeah.
yeah.
And then by middle of next year, you think we could be
So
at a minimum over six?
yeah, I think that, I mean, I'm expecting a sort of a big revision crisis, whatever you want to call it, but a change of view of the FOMC for the March FOMC next year, because that change of view that I'm talking about, it has to happen in the context of the macro projection.
Right. Okay. And then just in general, and I kind of touched on it, but let's just first go from, I guess, any of the comments from Fed speakers this past week. I think nothing new. You were just saying, like, kind of reinforced. They're being very clear right now. Not only will they have to raise rates fairly significantly, but most likely they will have to be there for a fairly significant period of time to address the issues that you're talking about. Yeah.
Totally. And which, to come back to your earlier comment about the soft landing, is completely inconsistent with the soft landing scenario. So I think what is going on here is that you have market participants looking at inflation relatively stable, but not really looking under the hood and under what drives the stability. And as often happens, extrapolating in a linear manner a trend that, that's been around for a very short period of time. And against that, you have the Fed that is finally acting as it should, as an a collective economics or economist mind. What a scary thought. And looking at the big macro picture and realizing that they really are not out of the wood. So that's what I'd say about the soft landing. Show me the slowdown in the labor market. I'll agree.
Yeah, you also have the ECB also talking tough and delivering, although obviously they're pretty late to the game, but
I mean, look at J, they are even further behind the curve.
Yeah. Were you surprised how markets reacted this past week?
I think there has been a change in market perception. I remember just a few weeks ago, people's view was that Europe didn't have an inflation problem because it was mainly food and energy. And I think, there is a realization that it's a much deeper problem. I mean, the bottom line and the way to look at all these inflation issues is its behavior. When inflation rises above a certain threshold, no matter the cause, whether it's food, energy, something else, behaviors start to change. Wages start to move higher and to try to catch up to prices.
Yeah.
And that is really the critical thing. And so I think markets realize that, the problems, inflation problem in Europe are deeper than our fault. And so the ECB has taken a step in the right direction, but is not in front of the curve, frankly.
Right. And also, I'm going to go off topic on Europe, but everyone's Europe's already in recession, everything. But I saw they still predicting 2% growth or something next year, which
it makes no sense to me. I mean, you have
But by the way, if they thought that growth is going to be 2% next year with the inflation numbers that are there, they definitely should have been raising rates much faster and much earlier than they have been doing.
Of course. But what we have here is institutional inertia. So we are coming out of 20 years plus of low inflation, even lower in the Eurozone than in the US. And so central bank have a delayed reaction. It's not great, but it's not illogical either.
Yeah. Besides obviously the stuff with energy in Europe, the fact that Europe has had negative rates for so long. This isn't just like a 1 or 2 year thing. And we always talk about it, macro hive, we're hypothesizing like what's going to break, what are the things. There's got to be like issues, outside the banking system, like alternative credit, or that there are issues that will probably come out in Europe before the US even, when something breaks. And by the way, I think central bankers are assuming some stuff will break, and they'll have to break to really slow growth. Okay, so I'm just looking through. So like the week ahead, I'm looking between your thing and also Bloomberg. There's a lot of stuff coming up. So let's, I guess, first start on the date. Nothing on Monday, it looks like, in the US at least.
We have Monday off.
But the rest of the week, pretty busy. Yeah, so what should people look out for? And are you expecting any, I know we're not there just to predict on like one piece of data, but are you predicting or expecting any significant numbers different than the street in any of this stuff? And also, which ones are the most important?
Okay, so not really, but I was really surprised by some of the street expectations. Anyway, let's go through the important numbers. The CPI. So the CPI, to me, 3 things are important: stabilization of core goods inflation, that's been falling, acceleration of core services inflation, and then a recovery in median price inflation. Because we have so much volatility, it's really hard to know what to pick, as the better indicator of inflation trend. So core inflation is not great because of the volatility in core goods prices caused by the supply shock. But if you look at measures like median price inflation or trimmed mean inflation is also quite volatile. So I've been harping on and on about
it's by nature of what it is, it's supposed to be not that volatile.
Yeah, but there are also, we need to look at all 3 basically. And basically it's all very noisy, but I'm expecting a recovery in the median price inflation, which is probably the least bad of the 3. Then the retail sales. And I was really impressed with the street because for all the talk of recession, they are actually predicting an increase in real retail sales, excluding oil and cars, of close to 1%, which is huge, especially since we have this ongoing transition between goods and services consumption. So this is actually
very silly question.
Yeah,
that's real retail sales.
Yeah,
you pull out inflation. Yeah,
exactly. Okay, we pull out the headline CPI, which is not perfect because retail sale is only goods and goods plus restaurants, but it's a good enough approximation. I'm always very wary of what I call spurious precision. These data are very noisy. So if you try to predict them too precisely, you can end up completely missing the big picture. So yeah, it's not perfect, but it's a good approximation. And the bottom line is that for all the talk of, the recession is upon us, actually the street is very optimistic on retail sales. So that's first day. Then the third most important data point, I think, is the PPI, which has been slowing. But the little gem that I'm looking at in the PPI is really the price of semiconductors, because we've had all this talk about, PC sales are falling, blah, 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 which is true. I mean, probably ordered too much. But if you look at the price of semiconductors, it's still increasing, which is actually super important because just about everything we buy has semiconductors in it. And prior to the pandemic, semiconductor prices were falling. they've been increasing very sharply initially, and now the increase is still has been slowing, but it's still there. So that is also an indicator of the extent to which supply is going back to pre-pandemic trends, and the evidence is that it's not. And that's one of the reasons I'm still have strong conviction on my inflation call. Then we have the University of Michigan Consumer Confidence. And again, I'm okay with the consensus on both headline, short-term, long-term inflation, which is basically the indices moving sideways. This index, and by contrast with the Conference Board Consumer Confidence Index, the Michigan is very focused on household financial situation, their perception of their financial situation, and very influenced by inflation. So I don't expect much of an improvement because I don't think inflation is slowing much.
I guess gasoline prices have come down, so that I'm assuming that has some kind of impact.
Yeah. But I mean, most of the improvement in gasoline prices is behind us. I mean, you saw the OPEC meeting with the small but symbolic decline in supply.
Just to say, hey, we can do it. And
and don't mess with us. Don't.
Exactly.
Yeah. So yeah, I mean, to be honest, I think the action this week is going to be in the UK, figuring out things with the new prime minister. The Europeans are still trying to figure out how they are going to ration energy. So these are interesting and important data points, but we have.
Do you see, and I had this discussion with Bilal as well, like, my only concern sometimes is, we may be, well, let's see what the numbers look like, especially inflation numbers this week, because the markets can continue to build on this maybe narrative that inflation growth's okay, even though we think in some cases the growth's accelerating, and inflation is moderating, and this means it will continue to moderate back down to the 2%. Which is not our view, but that could take time. So the markets may continue to risk rallies if CPI is fairly benign this week, which it may be. So you're saying the most important thing that people should look out for is the services component.
Yeah. The services component and the Fed. I mean, obviously, the Fed thought that, the Fed is gunning for the soft landing scenario. So if they are now accelerating the pace of hikes, it means that they are losing confidence in their soft landing scenario.
Yeah. Right. Exactly. Okay, cool. Anything else? Politics and that stuff? I know we're getting closer and closer to the short-term funding bill. Do you expect that to?
Oh, we're going to
week, I guess. Or is it always like the last 2 days or something?
Yeah, it's a usual theatrics. This time around, it could come from the left, but frankly, I wouldn't pay too much attention to it. Everybody knows that shutting down the government, being seen as responsible for shutting down the government ahead of the midterm would be political suicide. So we'll get, We'll
get some deal. But the Democrats it needs to be bipartisan?
No. But the Democrats, the left part of the Democratic Party, is unhappy with the idea of attaching a bill to the budget, which would make it easier to drill for energy, and which was part of the deal reached between Senator mentioned
Okay.
Senate Majority Leader Schumer this summer, which allowed the administration to claim credit for what is called the the Inflation Reduction Act, which was previously called the Build Back Better, or anyway, an albatross that the administration has been dragging for its first 2 years and got finally resolved thanks to this deal. And the left-wing Democrats are up in arms and say they will not vote the budget.
And then on politics, if it looks like and I'm sure it's still, I think it's like maybe even slightly likely that the Democrats hold the Senate but lose the House, which I guess is, inflationary is if Democrats continue to control both.
Yeah, I mean, basically what's inflationary is when one party controls House, Senate, and White House. And then it's spend, as we saw under Trump. And so if we want some fiscal restraint, we need to have the other party hold the Senate or the House.
Right. Okay. Okay, cool. Awesome. Anything else this week or?
No, good luck to our listeners, and please, reach out to us with questions, disagreements.
Right.
We love disagreements, so
yes.
that would be good.
Okay, cool. Thanks.
Thank you, Andrew. Bye.